tax consequences of homeownership. Gotta buy a house, live the American dream, right? We gotta always having property prices rise, making sure that the economy of this wonderful country keeps going up, and that I can never afford a house. Gotta love it. Long Island, never gonna be able to buy a house there, but we'll see at some point. Probably not. Probably not. Me living in a cardboard box. Y'all can come visit me there. A dwelling unit is a property suitable for people to occupy, such as a house, condominium, mobile home, or boat. That would be nice, actually. Maybe I'll just get a boat. I'll live in a boat. You all can visit me there, and we'll have cocktails at the South Shore. For tax purposes, a dwelling unit is classified as a residence or non-residence, so such as a rental property, based on its usage during the year. We've got a house, and there are a lot of tax rules about that. And why is that? Well, guess what? A lot of individual taxpayers own homes. As such, there's a lot of rules about them. So understanding the classification, very important here, something you're going to want to memorize. So personal use rules. In order for a property to be personal use, the owner or any other owner stays in the home. Relative of an owner stays in the home unless it's their principal residence. A non-owner stays in the home under a vacation home exchange. Don't really worry about that one as much. And the property rented for less than its fair market value. Otherwise, it's kind of like a lease situation. Rental use rules. We're going to talk about the days when the property is rented at fair market value and the days spent repairing or maintaining the home for rental use. Now, a dwelling unit is considered a residence if personal use days exceed the greater of these two, 14 days or 10% of the number of rental days during the year. So again, the classification for a residence, we'll see examples of how this works, but just like with a lot of topics, classification is the name of the game here. A taxpayer can only have one principal residence during a particular year, determined by factors such as time spent at each residence, proximity to employment, family's principal place of abode, and mailing address for bills and correspondence. Super important if you're wealthy and you have a lot of houses, so you can only have one house, because also that would make it complicated, right? If you had multiple primary residencies, are you a citizen of Florida or California or New York or Texas or Iowa? Where are you a resident of? You can only have one. You can have multiple. No one's stopping you from owning multiple houses. I can tell you that. I know a lot of people with multiple houses and a little jealous. I mean, come on, just give me one of them. So in summary, a dwelling unit can be classified as a principal residence, a residence which is not principal, so that's just a second house, or you have a rental property, right? So like you've got one house, maybe you got 5 houses, right? But only one can be principal. Let's say you got 3 other that your vacation homes, whatever, and then you've got one rental property. So a dwelling unit, we saw the classification for a dwelling unit. We want to classify that dwelling unit into one of these 3, and we'll see why that's important moving along. All right, we're seeing if a dwelling unit is considered a residency. Let's consider a dwelling unit that is both rented and used for personal purposes during the year. This is a very common situation, right? We get, especially now with the advent of Airbnb, Vrbo, all those things. Who knows? Maybe those will still be around if you're watching this video. I think they're still doing well. Who knows? I don't really know. The days rented for this property were 120 days, and the personal use days were 25. So looks like this was not their primary residence, because guess what? There's 365 days in the year. So it looks like other than the 145 days, they were somewhere else, or the house wasn't being used at all. So again, this house, this property, this dwelling unit was rented for 120 days, and the primary owner lived in it, the taxpayer lived in it for 25 days. So to determine if this is considered a residence, we must compare the personal use days, which we see here is 25, with the greater of, and we saw the rule on the prior slide, 14 days or 10% of the number of rental days. So 10% of 120 is 12. So in this case, the greater value is 14 days. And since the personal use days, which are 25, exceed the greater of these 2 values, the dwelling unit is considered a residence. We'll also build on this. We'll see why that's even more important as we go forward. But make sure you know how to do an example like this, something you can see on the exam. And like I said, we will build on top of this. All right, exclusion of gain on sale of personal residence. So we've got a lot of people owning homes in this country. And when you go to sell the home, that's everyone says, oh, that's your biggest investment in life. And for a lot of people, it is. And that's fair. Now, the IRS doesn't want everyone getting slammed with taxes when they eventually, I mean, yeah, they do. But would that be in the best interest of the American people? Probably not. So let's talk about this exclusion of gain on the sale of the personal residence. So this is going to be a benefit for you as the taxpayer, or you as the taxpayer and your spouse. We'll see here how the benefit gets doubled if you're married. Maybe an advantage to go get married. I don't know. I'm not the judge of that. When selling a personal residence, so you're moving, whether you're moving for work, you're moving because you want to, or you're just selling to go live on a boat, just like I'm going to someday, the taxpayer realizes a gain or loss. So that's what really happened. You sold it for $1 million and you bought it for $750,000. So you realized $250,000. That's what really happened. But what do you record? What is recognized? Let's talk about that, because what is recognized, what's recorded on the tax return, gets influenced by IRS rules, the IRC. So here, again, how do you realize a gain or loss? You subtract the basis of the home from the amount received. So pretty simple. It's the value you received minus the value you gave up. And the basis depends on how the home was acquired. And these will kind of go into other topics as well. Like we've got a whole gift tax lesson. We'll talk about inheritance and another one as well. So here, just a prelude to those, also just different varying ways to calculate basis. Obviously, we know that's incredibly important for the exam, is to calculate basis on varying types of assets. So that's nothing new. A personal residence is a capital asset. We see that as well in the lesson on talking about the different types of gains and losses and classification. We want to know what a capital asset is. So make sure you know a personal residence is classified as a capital asset, and its sale results in a capital gain or loss. That's very important because capital gains and losses are taxed differently than, let's say, ordinary income. However, losses on personal residence sales are non-deductible. Personal losses, not fun. You hate to see it. So again, kind of getting screwed out here. If you sell your house at a loss, you're not getting any benefit. But if you sell it at a gain, you may have to pay taxes on it, as we'll see. In contrast, gains on personal residence sales can be more favorable for taxpayers who meet certain requirements. The maximum exclusion depends on the taxpayer's filing status. So this exclusion has a bunch of criteria, which we'll see, in the next slide. Don't rush me, I'm getting there. So these are the maximum amounts that you can exclude from a sale. So before even getting into the criteria, we will deal with that. I promise you, I'm not pulling your leg or anything. Let's say we sell a house for $1.5 million. Godspeed, gotta love it. And we bought the house for $5 million. Let's say we meet all the criteria, which we'll talk about. What this means is that if we are married filing jointly, what would we have to pay tax on? Well, the difference, right? 1.5 million minus 5, that's 10 million. If we were married, we get $500,000 of a deduction here, so we'd only have to pay tax on $500,000. And let's say this is a single person, they bought a house for 5 and they sold it for 1.5. Well, they'd have to pay tax on 10, but then they get to deduct the $250,000. So they'd only have to pay tax on $750,000. So that's how that works. That's our introduction. If that was it, it'd be pretty easy. Not that it gets too much more difficult, but that's as simple as it gets. And then we will see the criteria in order to get this benefit. But that is the best benefit you'll get from selling your personal residence. And again, why did we go through those rules on determining what's a principal residence? Here it is, right? You're not going to get this if it's not your personal residence. We'll also see the criteria, how it works. Moving along to the next one. All right, so here, before even getting into the rules, again, just more numerical examples. There are criteria, so maybe these people are not eligible for it. Just want to run you through the numbers, build up to it, right? I'm not going to, hang out to dry. John and Jane, married couple, purchased a house for $300,000 in year 10. They decided to sell the house in year 23. After accounting for selling costs, they received $600,000 from the buyer. So we see here, what do they really benefit? They realized they really got $300,000 of value, gave up $300 in value, got $600. Cool, awesome, they got $300 in value. Now, since John and Jane are married filing jointly, the maximum exclusion is $500,000, and as such, $500,000 is greater than $300, so they don't actually owe any tax on this. Again, if they meet those criteria, which we will see. So awesome, very nice. You make a nice little profit on selling your house. You don't actually have to pay tax on it. You'll love to see it. All right, moving along with this topic. Here are our rules. As promised, we have criteria. We've got rules. We got to love it. There's rules for everything. Gains exceeding the excludable amount qualify as long-term capital gains, subject to preferential tax rates, right? So even if you are paying taxes on selling your house, at least you're not getting slammed with those ordinary tax brackets. We've got our long-term capital gains. Such gains are considered investment income for determining the 3.8% medical contribution tax on net investment income. So call back to there. To qualify for the exclusion, so all right, now we're getting into the criteria. How do you get the benefit of the 250 or the 500? We must meet both ownership and use tests for the residence. So the ownership test, taxpayers must have owned the property for 2 or more years during the 5 period ending on the sale date. to prevent house flipping, which you can house flip, no one's stopping you, but you'll pay taxes on those gains that you do from house flipping. And then we have a use test. Taxpayers must have used the property as their principal residence for 2 or more years during the same 5-year period, and the ownership and use periods need not be continuous or cover the same 2-year period. There are going to be a lot of different caveats to this. Not this like this rule stands, but a lot of different. Oh, okay, so we had the house for 10 years, but we lived in it the first 2 years and then lived in it the last 3 years. Does that count? Or let's say we lived in it for 1 year, rented it out for 6 months. So just keep in mind, we'll go through some examples here, but make sure you're getting into multiple choice questions, Sims, because this will get a little more complicated, but nothing you can't handle. Just that everything was once complicated until you practice enough, and then it is not. You can tackle it, be all good there. Some special rules here to keep in mind and consider. Married couples filing jointly can claim the full $500,000 exclusion if either spouse meets the ownership test and both meet the principal use test. Couples may still claim up to $250,000 if only one spouse meets both tests. So this is taking into account, let's say maybe one spouse is working across the globe or working somewhere else and living somewhere else. I mean, they're married filing jointly. It's just they can't be together or something like that. So just keep that rule in mind. Widow/widowers selling a jointly owned and occupied home within 2 years after the spouse who passed away, decedent spouse's death, can claim the full $500,000 exclusion. The IRS is saying, all right, it's give you 2 years. We'll let you claim a deduction. Yeah, you just had a pretty bad loss. Sorry to hear it. And then lastly, a taxpayer cannot claim another home sale exclusion until at least 2 years pass from the time of the first sale. Again, kind of trying to prevent house flipping. So just another rule. Keep all of these rules in mind. I would definitely make sure to memorize every rule here. And the best way to do that is through practice, by application, by seeing how they work in various scenarios. Let's run through an example here. We're going to have a lot of different years, dates we got to follow, but this is a good representation of what you can see. And then, of course, they could always make it a little more complicated. But John bought a house on January 1, year 1 for $200,000. He lived in the house as his primary residence until the end of the year on year 2. On January 1, year 3, John decided to move to another state for a job opportunity and rented out the house to tenants. John continued renting out the property until December 31st, year 5. On January 1st, year 6, John sold the house for $350,000. We're going to examine if John meets the 2 tests. Well, looks like for the ownership test, John owned the property from January 1st, year 1 to January 1st, year 6, so that looks like that is a 5-year period. The 5-year period ending on the sale date is from January 1st, year 1 to January 1, year 6. And John, in this case, will meet the ownership test, since he owned the property for more than 2 years during the 5-year period. For the use test, John used the property as his primary residence from January 1st, year 1 to December 31st, year 2, so that was 2 years. The 5-year period ending on the sale date is January 1, year 1 to January 1, year 6. John does meet the use test since he used the property as his principal residence for at least 2 years during the 5-year period. Since John meets both of these tests, he will qualify for the exclusion of the gain from the sale of his personal residence. So he sold the house for $350,000, bought it for $200,000. That'd be a realized gain of $150,000. But with that $250,000 exclusion, he's going to be scot-free, not paying anything. Not too bad. Next up, John and Jane together purchased a home in year 1 and lived in it as their principal residence until the end of year 2. They rented out the property from the beginning of year 3 to the end of year 3. Then they decided to move back in and use it as their principal residence again from the beginning of year 4 to the end of year 4. They then decided to sell the property at the beginning of year 6. In order to qualify for the exclusion, they have to meet both of these tests, so let's see if they do. Well, they own the property from the beginning of year 1 to the beginning of year 6, which is a total of 5 years. This meets the requirement of owning the property for at least 2 years during the 5-year period, ending on the sale date, so looks good there. And then for the use test, they use the property as their principal residence from the beginning of year 1 to the end of year 2, that was 2 years, and from the beginning of year 4 to the end of year 4, so that's another year. In total, they used their property as a principal residence for 3 years during the 5-year period. As such, the minimum was 2, so I think we're good to go there as well. Here, they would qualify again. See another example. Tom and Lisa, a married couple, purchased a house for $400,000 in year 10. They decided to sell the house in year 23. After accounting for selling costs, they received $950,000 from the buyer. what is the gain or loss? So first, I mean, you can do this for any of the questions. Not a bad step to do. It also depends. You could have a question asking, do they qualify for the exclusion? And it won't even ask for what's the amount afterward. Or you could have a question saying, well, what's the amount that they have to pay? We have a selling price of 950, a basis of 400. So it looks like we've got a realized gain of 550 here. Now the maximum exclusion they could get is $500,000. And if they meet both of the tests, the maximum exclusion is $500,000. As such, the taxable gain is going to be $50,000. Now, they can exclude the $500,000 of the realized gain, but they have to pay taxes on the remaining $50,000. The $50,000 gain is considered a long-term capital gain, subject to preferential tax rates. And then additionally, as we did mention, the $50,000 gain is considered investment income for the purpose of the 3.8% Medicare contribution tax on net investment income. Make sure you practice questions like this. We'll have plenty of them for you as you run through your multiple choice in Sims. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.